The title of this video might come off as a surprise when all we hear lately is how high the interest rates are. Of course, if we look at mortgage rates in the US over the last year, there is a huge increase. But the second we put things into perspective, the rates we have today are far from being the highest ones in American history. And even with all the hikes, the US still has some of the lowest mortgage interest rates in the world. How's that possible? By answering this question, I'll show you why not buying a house now might be a big mistake for you. In this episode, I'm also going to show you how you can make the most out of any situation regardless of how high the interest rates can be. The moment you tune into the media or YouTube, everyone keeps saying that now is not the time to buy a house, even if you want to. But are interest rates actually the most important factor to consider when investing in real estate? Baby boomers know what I'm talking about. They're believed to be one of the wealthiest generation. It's partially because they could buy a house more easily as real estate cost less back in the days and was more affordable compared to their income. At least that's what it seems. But you know what? Most baby boomers bought their homes in the late 70s and the 80s. And those were times of some of the highest mortgage rates in American history. In 1981, the average rate for a 30-year fixed mortgage reached an all-time high record of 18.39%. And this was the average. So some people pay more than that. I know it sounds crazy, but this was the reality of Americans only 40 years ago. The next argument I often hear is that back then, home prices were much lower, so the houses were much more affordable. Of course, if we look at the median sales price of a home sold in the US, its value skyrocketed. But the affordability isn't that straightforward. I came across this article from Forbes that I really want to share with you because it was very eye-opening for me. Two economists, Marian Tupy and Gail Pooley, wrote this blog sharing their research on how housing affordability changed in the last 40 years. What they did was consider the following parameters: the median house price, the median mortgage rate, the average size of an American home, and the average blue-collar workers' compensation rate. The researchers compared this data for 1980 and 2020, and when they made their calculations, it turned out that, on average, Americans need to work only 3.1% longer to get enough money to buy a square foot of housing in the US. How is that possible? Look at this comparison. The price of a house grew by over 400%. But at the same time, the houses also got much bigger. The mortgage rates dropped significantly. Here, they use data from 2020. But even the interest rates we have now are much lower compared to the 80s. The monthly payment in 2020 was almost 2 times higher than in 1980. But the monthly payment per square foot didn't increase much because, again, the houses got more spacious. The hourly compensation grew significantly, which resulted in fewer working hours needed to cover the monthly mortgage payment. Of course, in 2021, the housing prices got out of control. So the situation now is slightly different, but it is far from being as bad as everyone says it is. Besides, the average down payment for a home in 1980 was 28% of the purchase price. Now, according to the National Association of Realtors, the average first-time homebuyer pays only 6 to 7% upfront for their down payment, while the average down payment for repeat homebuyers is around 17%. Yet, there is a serious issue we might be facing now with the higher interest rates, and it has to do with the housing shortage, which has gotten worse over the years. Today, many people don't want to lose their locked low interest rates, so they don't put their houses on the market even if they want to sell. But despite that, thousands of Americans are getting mortgages every day. In 2022, the US top 10 largest mortgage lenders alone gave out almost 2 million mortgages. The biggest one of them, Rocket Mortgage, originated loans with a total worth over $120 billion in 2022. In 2021, a year of boom, this number was almost 3 times higher, more than $340 billion. Looking at these numbers, it is impossible not to wonder, where do banks get all this money from, year after year? Now, This is a secret to how the US manages to keep rates relatively low even when fighting the highest inflation in decades. Let me introduce you to Fannie Mae and Freddie Mac. These may sound like the perfect names for a funny couple, but in reality, these are two agencies that guarantee a secure and liquid mortgage market. The Federal National Mortgage Association, known today as Fannie Mae, was created back in 1938 by the US government when home ownership was unattainable for most Americans. Its main goal was to ensure affordable and reliable mortgages throughout the country. And it worked. In fact, Fannie Mae's efficiency led to the creation of the Federal Home Loan Mortgage Corporation, popularly known as Freddie Mac. Fannie Mae and Freddie Mac are the core blocks of the whole American housing market. Together, they guarantee over 70% of all mortgages, but you, as a borrower, don't even interact with them. So how does it work then? Let's say there's a lender, a bank, credit union, etc., which gives you a loan. But banks don't have enough liquidity to keep lending to everyone. So to make housing more accessible, the US government created two corporations, Fannie Mae and Freddie Mac. What they do is basically buy the loans that lenders give to Americans. They keep some of them, but the majority of mortgages are packed into mortgage-backed securities or MBS. And then they sell these securities to investors. They're considered to be as safe as treasury bonds. Mortgage-backed securities sort of became one of the Fed's biggest investments. The Federal Reserve started to buy them actively after the 2008 crisis and then during the pandemic. When investors buy these securities, they inject more money into Fannie Mae and Freddie Mac so they can buy more loans from the banks, giving them the opportunity to lend more money to Americans. This system gives more liquidity and stability to the US housing market, but it isn't perfect either. The management of Fannie Mae and Freddie Mac was involved in several scandals, and they failed during the 2008 crisis. The government had to bail the agencies out with a record $191 billion with taxpayers' money. That's why many understand that there is a strong need to improve the system because Americans are the ones at risk in the end. For years, both Democrats and Republicans discussed the restructuring and privatization of Fannie Mae and Freddie Mac.
There is a bipartisan group of senators working to end Fannie and Freddie as we know them.
Fannie Mae and Freddie Mac are falling after the Trump administration revealed plans to privatize the mortgage giants.
These changes might be for good, but if there were no Fannie Mae or Freddie Mac as we know them today, the mortgages might get more expensive and less accessible. That's why you can spend weeks, months, and years trying to find the best time to buy a house. But it doesn't make much sense. The best advice financial experts give is to buy when you're financially ready and can afford the home you want. The interest rates are secondary. Besides, you shouldn't be stuck with your mortgage rate forever. If rates drop significantly, you can refinance later on and cut the costs. Remember that average mortgage rates are just a benchmark. If you have a strong borrower's profile, you can often get mortgage rates well below the industry norm. So instead of worrying about the rate hikes, try focusing on factors that impact your mortgage interest rate, such as your credit score. In this channel, we talked a lot about how to achieve a healthy credit score. So if you want to get more information about that, feel free to check this video after you're done with this episode. Generally speaking, a credit above 720 will open more doors for lower mortgage interest rates, helping you save thousands of dollars in interest. The next essential factor you should consider is your down payment. It commonly ranges from 3 to 20% of the purchase price. The amount of the down payment matters because you might get additional expenses. For example, if you put less than 20% down on a conventional loan, you might need to pay for a private mortgage insurance, PMI, which can be added to your monthly payment. In this case, we're talking about a conventional loan, which means a loan that the government doesn't back. But if you get qualified for some home ownership assistance program, the required down payment might be different for you. For example, the Federal Housing Administration or FHA loans normally have a 3.5% down payment requirement. At the same time, VA and USDA loans might not require a down payment at all. VA loans are available to U.S. military veterans, active service members, and their families, while USDA loans are backed by the U.S. Department of Agriculture to stimulate homeownership in rural areas nationwide. So the best option is to see if you qualify for any of these programs. But if you end up getting a conventional loan with a down payment of 20% or above, consider different down payments to see how you can reduce your housing costs. There are 3 other essential concepts you should consider to get the best deal. Those are loan type, loan term, and loan amount. Now, let's see how each of them influences your mortgage rates. First, let's take a look at the loan type. Basically, you can have a fixed rate and an adjustable rate. Of course, adjustable rate mortgages generally offer lower introductory rates compared to fixed rate mortgages. Yet, those rates will likely change after 5, 7, or 10 years of the initial fixed rate period. So you won't be able to lock in the lower rate you took years ago. It might still be fine if the rates don't fluctuate much or even decrease. But if they do go up, you might end up paying much more than expected at the beginning. Whereas the fixed rate normally allows you to refinance if the rates get significantly lower. You can also bail out of an adjustable rate mortgage and switch over to a fixed rate by refinancing your existing loan. Remember that refinancing is considered applying for a new mortgage. Therefore, you will have to pay for closing costs again, which are usually 2 to 5% of the new loan. The next factor is the loan term. Obviously, 30-year fixed-rate mortgages are some of the most popular ones, but in some cases, you can consider getting a 15-year mortgage. On average, an interest rate is always from 0.5 to 1% lower for a 15-year mortgage. And over the loan lifetime, you will have some significant savings compared to the 30-year mortgage. Let's see an estimation to give you a clearer picture. Let's say, for example, you're getting a $300,000 house and making a 20% down payment, which is the equivalent of $60,000. If you get a 30-year fixed-rate mortgage at 6.71%, which, according to Freddie Mac, is the average as of June 2023, your mortgage payment will equal slightly over $1,850. This way, you will pay more than $318,000 in mortgage interest over the course of the 30-year mortgage. Now, let's see what happens if we take a 15-year fixed-rate mortgage. First, the interest rates will be a bit lower. Again, according to Freddie Mac, the average is now at 6.07%. We see here that the monthly payment rose significantly, but the mortgage interest is more than 2 times lower. Of course, now the 15-year loan looks much more appealing, but remember that you should only consider shorter loans only if you are sure that you will have enough income to cover living expenses, have savings, or put some money away for retirement. For those looking to get a custom calculation to help you decide whether you should go for a 15 or 30-year mortgage, check out this episode after you're done with this one. The loan amount is another essential factor you should take into account. Rates on unusually small mortgages like $50,000, for example, are often higher than the average ones. This happens because they're less profitable to the lender, so they compensate for that by charging higher interest rates. On the other hand, jumbo mortgages also tend to have higher interest rates because of higher risk. In 2023, the Federal Housing Finance Agency raised the maximum conforming loan limit for a single-family property to over $720,000. In certain high-cost areas, this limit is now $1 million. A conforming loan is one that meets Fannie Mae and Freddie Mac guidelines. All these details might be overwhelming, but they can help you a lot when buying a house and cutting the cost of your monthly payments. So remember that whatever the news is, panic is the worst enemy of good decisions. And more often than not, things turn out to be better than we think. It is also much easier to navigate through any event if you have a better understanding of finances and markets. For this, we created this free webinar to teach you how to invest in real estate the right way. Here's the link down below, and I will see you in the webinar. Take care. Bye-bye.